On the third Friday of most months, something strange happens to the stock market in its final hour. Thousands of individual stocks and the big indexes themselves seem to drift toward very specific prices and then stick there, as if held in place by an invisible magnet. Traders have a name for it. They call it pinning. It is not a conspiracy, and it is not random. It is the mechanical footprint of the options market left behind as billions of dollars of contracts expire all at once. On these days, the firms on the other side of those options are forced to trade the underlying shares in a very particular way, and that forced trading can quietly pull prices toward the strikes where the most money is sitting. This is the story of what dealers actually do at expiration and why the market so often pins. Here is the core idea stated plainly. When a huge amount of options open interest is concentrated at one strike price, the stock often gravitates toward that price as expiration approaches. The strike with the most contracts outstanding behaves like a center of gravity. You do not need to trade a single option to notice this. You just need to know where the big strikes are. The reason it matters is that expiration is not a quiet bookkeeping event. It is one of the busiest, highest volume moments of the entire month. And on the 4 quarterly dates, it is the single largest in the market. Understanding why prices cluster on these days explains a pattern that millions of investors see, complain about, and almost never have named for them. The mechanism is hiding in plain sight, in the hedging behavior of the firms that sell options for a living. Start with the calendar. Standard equity and index options expire on the third Friday of every month. That monthly date is already heavy, but 4 times a year, in March, June, September, and December, something bigger happens. On those third Fridays, 4 different kinds of contracts expire at once. Stock index futures, stock index options, single stock options, and single stock futures. Traders nicknamed it triple witching and later quadruple witching, and the scale is genuinely hard to picture. In December of 2025, by Goldman Sachs estimates, a record $7.1 trillion in notional options exposure expired on a single day, including about $5 trillion tied to the S&P 500 alone. The March 2026 event was about $5.7 trillion, the largest March expiration in Citigroup data going back to 1996. The previous June ran around $6.5 trillion. These are not normal trading days. They are pressure points, where positioning that has built up for months is suddenly released. So the natural question is this: when all of that expires at once, who has to do something about it, and what exactly are they forced to do? The answer is the heart of this whole phenomenon, and it comes down to one job: hedging. When you buy or sell an option, a dealer, a market maker, usually takes the other side. Dealers do not want to bet on direction. They earn the spread, so they try to stay neutral by holding an offsetting amount of the underlying stock. That offsetting amount is called delta, and the catch is that delta is not fixed. As the stock price moves, the delta of an option changes, so the dealer has to keep adjusting the number of shares they hold to stay balanced. The speed at which delta changes has its own name. It is called gamma. Now here is the part that only switches on near expiration. For an option sitting right at its strike price, gamma becomes enormous in the final hours because the contract is about to become either fully in the money or worthless, depending on which side of the strike it lands. A tiny move in the stock can suddenly flip the hedge a dealer needs. When dealers are positioned long gamma around that strike, their required hedging runs against the move. They sell shares as the price ticks up toward the strike, and they buy shares as it ticks down. That is mechanical, and it is stabilizing. It quietly pushes the price back toward the strike from either side. Multiply that by thousands of dealers hedging the same heavily traded strikes at the same moment, and you get the magnet. The stock keeps getting nudged back to the level where the largest pile of expiring contracts sits. That is pinning. It is not anyone deciding the price should be there. It is the sum of a vast number of automatic hedging adjustments, all pointing at the same number at the same time. This also explains why expiration has a rhythm. The pull is weak in the morning and strongest in the last hour, because gamma intensifies as the final bell approaches, and there is less and less time for the contract's fate to change. On triple witching days, studies of historical volume show that a large share of the day's trading, often around 40%, clusters into the final stretch after 3 in the afternoon, exactly when this hedging is most intense. There is even a popular shorthand for where the magnet points. Traders call it max pain. It is the strike price at which the largest dollar value of options would expire worthless, which is also, roughly, the price that forces option buyers to give up the most and lets the sellers keep the most premium. Max pain is not a law, and it is not a forecast you can lean on. But it captures the intuition correctly. Prices tend to drift toward where the open interest is densest, because that is where the hedging pressure is greatest. The important nuance is that this only holds while dealers are net long gamma around those strikes. When they are short gamma instead, the same mechanism reverses, and hedging pushes prices away from the strike rather than toward it. So how do we know this is real, and not just a trader's superstition? Because it has been measured. In a landmark study published in the Journal of Financial Economics in 2005, 3 researchers, Nee, Pearson, and Poteshman, examined years of expiration days and found that the closing prices of optionable stocks really do cluster at strike prices far more often than chance would allow. They estimated that on a typical expiration date, the returns of stocks with listed options were shifted by an average of at least 16.5 basis points, and that the aggregate effect moved something on the order of $9 billion of market value toward the strikes. They traced it to exactly the forces we just described: hedge rebalancing by option market makers, and in some cases, deliberate trading by firms with positions to protect. The people this affects are not the dealers, who are hedged either way. It is everyone else. The investor who sees a stock mysteriously freeze near a round number on a Friday afternoon and assumes the market has simply gone quiet. It has not gone quiet. It is being held gently by the weight of expiring contracts and the hedging they demand. And once those contracts are gone, the following Monday, that particular magnet vanishes. So what do you actually take from all of this? Not a trade and not a prediction. The lesson is that price near expiration is not a pure reflection of fresh news or fundamentals. Part of what you are watching is plumbing, the mechanical residue of options being hedged into their final hours. Pinning is a tendency, not a rule. It shows up most clearly in calm markets, where dealer hedging is the dominant flow, and there is no strong directional tide to fight it. When real news hits, or when dealers are positioned short gamma, the pin breaks, and the same machinery that calmed the tape can amplify the move instead. So the useful habit is not to guess where a stock pins. It is to recognize, on a heavy expiration day, that some of the price action you are seeing is structural rather than informational. The forward question is the interesting one. As more and more trading concentrates into options that expire the same day, the gap between an ordinary session and an expiration session keeps shrinking. So what happens to pinning when, in effect, every afternoon starts to look a little like the third Friday? If breakdowns of the market's hidden machinery are useful to you, there are more of them here. This channel explains how markets work. It is educational, and it is not financial advice.